Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Abbott Laboratories stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Abbott Labs is a medical device and healthcare company. The company is headquartered in North Chicago, Illinois, and was founded in 1888. It went public in 1984 and currently trades on the NASDAQ. It sells medical devices, diagnostics, branded generic medicines, and nutritional products. It split off its research pharmaceutical business into AbbVie in 2013. Its well-known products are Pedialyte, Similac, Ensure, Glucerna, Zone Perfect, iStat. Let's get started with the model. This is a large cap company, 207 billion market cap. They're trading at $117 a share, and they have 1.8 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has a lot of free cash flow, 4.4 billion, way up to 5.7 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. That was low in 2017 and peaked in 2020 at 4.5 billion. Revenue is a sales for the company, and that grows nicely each year from 27 billion to 34.6 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example of cost of revenue is cost of labor. The difference between those two numbers is their gross profit, and that grows each year, peaking at close to $20 billion. Below that is operating expenses. Examples are research and development and depreciation. Then below that is operating income, and that tripled from 2017 from 1.7 billion to 5.4 billion. Below that is the interest they pay in their debt. They seem to be paying less interest each year, from 780 million to 500 million. Below that is other income and expenses. That's usually impairments or other non-operational gains and losses. Then you have your pre-tax income, then your taxes. And they had their highest net income in 2020 at 4.5 billion. The reason they had low net income was this huge tax expense. They had pre-tax income in 2017 of 2.2 billion, yet they paid 1.9 billion of taxes. In 2017, the US government applied a one-time tax penalty to companies that were keeping money overseas. Some companies were keeping money overseas to avoid paying taxes in the United States. Since this is a one-time tax penalty, this is merely a blip. It shouldn't affect future net incomes. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. That grew from 5.6 billion to 7.9 billion. Net income is your accounting profit and loss. It's not actual cash. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Free cash flow is the cash that's remaining to pay a dividend, to buy back stock, to pay down debt, or to invest back into your business to grow it. This company has $3 billion in annual dividend payments. But another way to reward shareholders is to buy back stock. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. They bought back 800 million in 2017, then 200 million, 700 million, then 400 million. They do issue debt every year, 6.7 billion in 2017, but they paid down more debt than they issued, 8.7 billion. So they decreased their debt load $2 billion in 2017. They decreased it $8 billion in 2018, then decreased it a little over $1 billion, then decreased it very little in 2020. Let's look at the capital structure. $33 billion of equity, $19 billion of debt. They're 63% equity, 37% debt. Their net debt is $12.5 billion. Net debt is total debt minus cash. And their WACC is 6.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $197 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $177 billion. We divide that by 1.8 billion shares, and we get a calculated stock price of $100. They're trading at $117, so they're trading at a 17% premium. It's a sell according to the model. Simply Wall Street is at 101, so they're really close to me. They're also saying the stock is overvalued. In the last 3 months, 10 analysts rated this stock, and their average price target was 135. So they're saying the stock is undervalued. Everybody has their own spin on things. We all use our own models and look at the numbers a little differently because it's hard to predict the future. There's no one correct way to do it. I did a video back on Abbott in June, and my calculated stock price was $90. The stock was trading at $88 at the time. This is the stock price the last 5 years, so the stock has pretty much only gone up. It did peak a couple weeks ago and there was a pullback, but I'm sure the stock price will go back up. This company is a cash machine. It seems to generate a lot of cash and their revenue keeps growing. And this company raises their dividend every year from 26 cents in 2016 up to 45 cents currently. They pay a 1.54% dividend yield. And they pay out 71% of their net income and 56% of their free cash flow. Their dividend of 1.5% is higher than the industry average of 1.2%. The bottom 25% of the market pays a 1.3% dividend, so they're higher than the bottom 25%. The top 25% of the market pays a 3.5% dividend, so they're a lot lower than that. They have a pretty low beta, 0.72, so the stock moves less than the market. It's not volatile. The stock has gone up 58% in the past 52 weeks, while the S&P 500 went up 65%. The 52-week high was 128, the low was 61. The stock is trading below its 50-day, but above its 200-day moving average. About 5 million shares are traded each day on this stock. Of the 1.77 billion shares outstanding, 1.76 billion are on float. 76% of the shares are held by institutions, and about 1/2% of the shares are shorted. If you held this stock for 1 year, you'd be up 45%, including dividends. The industry is 46%, so they're a little lower than the industry. The entire market is 59%, so they're lower than the market. But in the past 3 years, this stock is up 94%, which is much better than the industry of 65%, and even better than the market of 54%. In the past 5 years, this stock is up 215%. The industry is 146%, and the market is 120%. Analysts forecast the future earnings of this company to grow 12.7%. They expect the industry to grow 17% and the market to grow 19%. The same thing with revenue growth. They're projecting this company to grow 6.2%, the industry 9%, and the market 10%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be pretty happy because you'd be at $64,000 today. That's an annual return of 20%. Vanguard is the biggest shareholder at 8.3%, then Capital Research, BlackRock, State Street, and Wellington. Let's look at their financial ratios. The average PE in the market's 8.4, the median is 13.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 46, so investors are paying $46 for $1 of earnings. Price to sales is stock price over sales per share. They're at 6.0, which is between the median and average. Price to book is stock price over book value per share. They're at 6.3. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $33 billion of equity, negative $5.7 billion of tangible equity, because they have $38 billion of intangible assets on their balance sheet. The way a company gets intangible assets on their balance sheet is when they acquire another business. They acquire a lot of companies. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments 10 times. ROE is net income over equity. They have a really good ROE at 14%. Current ratio is current assets over current liabilities. They're at 1.7, so they can easily cover their current liabilities with their current assets. And their current assets are $7 billion of cash, $6 billion of receivables, and $5 billion of inventory. The company is well capitalized. They had $5.7 billion of free cash flow, $8.5 billion of working capital, and they have a $3 billion dividend payment. So they have over $11 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 3 other companies in the same industry as Abbott. And if Abbott has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They have the worst PE ratio of all the companies. They're doing well in price to sales and price to book. They have the highest current ratio. They're tied with a line. They have the lowest ROE of all the companies. They're higher than average in debt. And they're by far the biggest company in this industry. They're bigger than all these companies combined. And they do pay a dividend. The other 3 companies don't. So to summarize, I have them trading at a 17% premium, but this company has been around a really long time. This is a solid long-term investment. In the short term, I'm not sure what's going to happen, but in the long term, I'm pretty confident this stock will go up over time. I rank their free cash flows 9 out of 10, their revenue 9 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.